Mortgage rates are dropping. That's the headline. And if you listen to the expert, that's supposed to be good news, right? Lower rates, more buyers, more affordability. But here's the problem. If rates are falling, why does housing still feel completely out of reach for most people? Tonight, we're going to break down what's actually happening in the mortgage market, why the same levers keep getting pulled, and why none of this is fixing affordability, because once you see it, you cannot unsee it. Now, we're seeing three big moves happening all at once. First, mortgage rates are easing after staying high for years. Second, there's talk about pushing more money into the mortgage system, including forcing government-backed buyers like Fannie Mae and Freddie Mac to absorb more mortgage bonds. And third, politicians are floating ideas like banning institutional buyers, loosening lending standards, and even stretching mortgages out 40 or 50 years. On the surface, it sounds like action, but underneath it, this starts to look very, very familiar. Here's a simpler version most people never hear. When you get a mortgage from a bank, that bank usually does not keep it. That bank sells it into the secondary market. That frees up capital so the bank can make more loans. So, when the government pushes more money into the system, into that system, the theory is great. More lending, more buyers, more homes sold. But there's a catch. Housing affordability is not just about rates. It's about price. It's about inventory. And it's about income. Right now, inventory is still tight in most markets. Builders are not incentivized to build truly affordable homes. Wages have not kept up with home prices. So when rates fall, what usually happens? More buyers rush in. Demand spikes. Prices rise again. You don't fix affordability. You simply reset the pressure. That's why people feel like they're chasing a moving target. And this is where it gets a little bit more uncomfortable. We're hearing ideas like longer mortgages. We're hearing ideas like fewer credit requirements, looser lending standards. And we've seen this movie before. Back in the mid-2000s, the goal was the same. Get more people into homes. The problem wasn't intention. The problem was math. You cannot fix affordability by ignoring risk. Stretching loans does not make homes cheaper. It just spreads the cost thinner and longer. Now let's talk about the push to ban institutional buyers. The claim is that big firms are pricing regular people out. But here's the uncomfortable truth. Most everyday buyers aren't losing bidding wars to hedge funds. They're losing to high prices. They're losing to high taxes. They're losing to high insurance and stagnant income. Blaming institutions feels good politically, but it does not create inventory, and it does not lower prices on its own. And here's the part that no one likes to hear. Markets don't wait for politics to fix things. They just don't. Opportunity usually shows up during uncertainty, when other people are frozen. That's why experienced investors don't panic during confusion. They look for leverage, patience, and long-term positioning. They don't look for hype. They don't look for shortcuts. And they certainly don't look for free money promises. And I want to be very clear here. This is not financial advice. This is not a pitch. This is simply transparency. What we have to focus on is tangible assets, disciplined deals, and long-term thinking. Some people invest directly in property. Some people pool resources. Some people do nothing. The point isn't what you choose. The point is that waiting on policy alone rarely ever works. Lower rates will not save affordability. Politics won't fix housing overnight. But understanding the system gives you clarity. And clarity is where the real decisions start.